Fed funds futures trading since the statement was released shows that investors still think that another rate cut is coming this year. On their behalf, let me ask, what is going to guide Fed policy to either pull them towards where the dot plot suggests no more moves this year, or keep them in place? Are you reacting to data now? Are you reacting to your gut feeling about what trade tweets might mean? Should they just watch for Jay Powell's speeches to decide what's going to happen going forward? What's the Fed's reaction function now?
Right. So what we are looking for through all of the data, all the events that are going on around the world, we'll be looking at, the evolving geopolitical events. We'll be looking at global growth. We'll be looking at trade policy uncertainty. Most importantly, we'll be looking at the performance of the U.S. economy. We'll be looking for things that are affecting the outlook for the U.S. economy, particularly the outlook as it relates to maximum employment and stable prices. So all of those things in principle can affect the achievement of our goals. It's an unusual situation because, the U.S. economy itself, the largest part of it, the consumer part of it, is in strong shape. The manufacturing part, less so. But overall, you see an economy that I think generally forecasts show growth similar to our own forecasts, coming at about 2%, which is a good solid year. So the difference here is we have significant, really, risks to that outlook from not just the geopolitical events, but also from slowing global growth and trade policy uncertainty. So we'll be looking at all of that, and also financial market conditions and how they are affecting the outlook. I can't. It's a challenging time. I admit it, but we really have to be open to all those things. We're not on a preset course. We're going to be making decisions meeting by meeting as we see this, and we'll try to be as transparent as we can as we go.
Hi, Chairman Powell. Donna Borak with CNN. With the rate cut today and potentially another modest adjustment coming down the road, do you worry about lessening the Fed's firepower should there be a recession? And is there any scenario in which you would envision rates drifting lower into negative territory? And are there any other tools that you could use before having to go there? Thanks.
In terms of firepower, I think the general principle, as I mentioned earlier, is it can be a mistake to try to hold on to your firepower until a downturn gains momentum, and then there's a fair amount of research that would show that that's the case. Now, I think that principle needs to be applied carefully to the situation at hand. What we believe we're facing here, what we think we're facing here, is a situation which can be addressed and should be addressed with moderate adjustments to the federal funds rate. As I mentioned, we are watching carefully to see whether that is the case. If, in fact, the economy weakens more, then we're prepared to be aggressive, and we'll do so if it turns out to be appropriate. You mentioned negative interest rates. So negative interest rates is something that we looked at during the financial crisis and chose not to do. We chose to, after we got to the effective lower bound, we chose to do a lot of aggressive forward guidance and also large-scale asset purchases. And those were the two unconventional monetary policy tools that we used extensively. We feel that they worked fairly well. We did not use negative rates. And I think if we were to find ourselves at some future date, again at the effective lower bound, again, not something we are expecting, then I think we would look at using large-scale asset purchases and forward guidance. I do not think we'd be looking at using negative rates. I just don't think those will be at the top of our list. By the way, we are in the middle of a monetary policy review where we're looking through all of these questions about the longer-run framework, the strategy, tools, and communications, and we expect that to be completed sometime around the middle of next year.